Hi everyone, welcome back to my YouTube channel. For those of you who joining me for the first time, I like to talk about investing and personal finances in general. So if you like my video, please click the like button. Also, if you like this subject, click the subscribe button so that you get notified whenever I create new videos. I try to post new video once a week or so. Today, I wanted to talk about stock market timing and whether it's a good strategy. The reason I thought about this subject is because of what happened a few months ago. The stock market dropped 37%, and then literally within a month, it's recovered. So should we be trying to time the market? After all, it's very tempting. Why settle for 5 or 10% a year when you can time it and make 30, 40 or more in just a few months? Well, the problem is it's easier said than done. It's not any different than trying to pick winning lottery numbers. After all, it's only 7 numbers out of 49. How hard can that be? Yet, the odds are against you. Same with timing the stock market. As much as some people tell you that they can predict when it's going to go down, when it's going to go up, nobody has a crystal ball and nobody can predict the future. There's simply too many variables. Now, if you have read any investing books and watched any videos online, 99% of those tell you not to time the stock market. Basically, be invested in it fully and just try to do dollar cost average, which basically means try to keep investing on a regular basis so that you catch lows and highs. And to be honest, that's what I've been following until recently, until a few months ago, when the stock market went down 37%, and I really wish I had some cash on hand because there were a lot of good companies selling at discount. So that made me actually think about the whole thing. Do I actually have a right strategy? And to be honest, I came to the conclusion that no, I don't. Now, the number one argument against timing the stock market is this. As you can see, simply missing 10 best days in the stock market drops your average from almost 6% to 2. Missing 20 best days in the stock market will make you go into negative. And that can very easily happen because just think about it. It's 20 days in 20 years. All you have to do is miss one day a year and you're actually going to be in the negative. So what's the right answer then? Well, I personally starting to think it's somewhere in the middle. So here's my strategy from now on. So what's the best strategy? After doing more research, I realized that although a lot of people tell you not to time the stock market and just be fully invested in it and ride highs and lows, a lot of those people don't actually do that. They tell us to do it, but they don't actually do it themselves. Let's take the most famous investor, Warren Buffett, and use him as an example. Back in 1988, Warren Buffett purchased Coca-Cola for $1 billion. By 1989, Warren Buffett owned 1.8 billion of it. Considering that his company was worth 4.9 billion at the time, that means he invested 20% of his cash into Coca-Cola. Now, let's fast forward 30 years. Today, Warren Buffett sits on $137 billion in cash. Now, I know this is an older article, it's from March, and since then he spent about $10 billion on some utility assets, but that means he still sits on around $130 billion of cash. And that's considering that his total investments are $225 billion. So still, that means that his cash comprise more than 50% of his total holdings. And that makes sense because if you look at the history of Warren Buffett investments, a lot of it was done when the stock market was down, when a lot of people didn't want to buy anything, when a lot of companies were running low on cash. The same happened in 2008 financial crisis. He actually bailed out some of the banks and bought a lot of stocks and with a lot of different options. Because of that, going forward, I'm also thinking of keeping some cash reserve just in case the stock market tanks again. And right now, what's happening with the coronavirus, I think there is a lot higher chance of it happening than, let's say, a year ago when the economy was booming. Because after all, if you think about it, Currently, we have a huge disconnection between the stock market and overall economy. Usually, when you have such a high unemployment, the stock market will be going down as well. Yet, it's almost at the all-time highs. There's multiple reasons for it. Some of them I talked about in my previous videos, such as government printing tons of money and giving it away, and some people actually making more now on government checks than they were making at their place of employment. And so they start basically gambling with it and throwing it into the stock market. And with companies like Robinhood, it became very easy. Because if you actually looked at the graph of number of registered users at Robinhood, it skyrocketed since the coronavirus came into play. And all this money basically props up the stock market. But it cannot go on like this forever. Right now, in my opinion, stock market artificially inflated. But the second government's gonna stop giving free money to everyone, most likely it will go down. Because companies not gonna hire everyone right away. Because everyone will be very cautious, trying to figure out where everything is going. I mean, we don't have a vaccine right now. There's tons of news from everywhere where there's a second wave of coronavirus infections is coming. Then there will be fall and winter. More people are going to be sitting indoors, and most likely infection rates will increase again, just like regular flu. So yes, I think there's definitely some uncertain times coming ahead of us. And I think having some cash on hand could benefit greatly. Now, how much should you have in cash? 50% like Warren Buffett? I think it all depends where you are with your investment. If you're just starting, I honestly think maybe you don't even need to have any cash on hand. Just keep, investing. Try to dollar cost average. Try to invest regularly. On the other hand, if you've been investing for a while and you have 50 or 100,000 or more, then maybe you should have 5 or 10, maybe 15% in cash. Like I said, if overall economy is strong and there is no sign whatsoever of any problems ahead, yeah, maybe you should have less in cash. But in today's environment, I think it's worth having some cash buffer to take advantage of any stock market fluctuation. Because after all, even the greatest companies do go down with overall stock market. They may not go down as much, but they do go down. For example, Johnson & Johnson went down 22%. And there's literally no reason for it whatsoever. Because it's a great company. They're sitting on tons of cash. It's one of only 2 AAA credit rated companies in the United States. And that's actually better credit rating than the US government. So there was no reason whatsoever for it to go down. But what happens is, when the stock market goes down, basically every single company goes down, whether there is a reason for it or not. So yes, I would have loved to buy more of it at $109 instead of $150 that it's at right now. So that's my plan. Have between 5 and 10% in cash. I'm gonna keep purchasing companies, but I do want to have a reserve of cash because I want to be ready if anything similar happens again. Please let me know what you think, what are your strategies, and if you would do anything different. Thanks again for watching my video. Again, if you liked it, please click the like button. It will help me with the YouTube algorithm. As more people view it and it becomes more popular, that will give me incentive to create more videos. Thanks and take care.